Should I kick off, Gerhard?
Yes, I think so. Maybe if you like, I mean, it's up to you what you talk, but maybe the best would be maybe if you start to talk about yourself a bit so that people can learn from your, stellar career.
Okay. I'll talk a bit about myself. Let me. I haven't really prepared anything formal, but I've literally written down like 5 things. I thought
that's enough. That's good enough.
Maybe too many. Okay, so I'll give a bit of my own background. So first of all, delighted to be here. Thank you, Gerhard, for inviting me. Also delighted to be at Trinity. So I joined in September of last year. So approaching my first year anniversary, though I only formally became Senior Bursar in January. I had a brief overlap with Rory, who many of you will know, I think my predecessor. So my background before here is I studied at Cambridge, but not at Trinity, up the road at Churchill. And then I've spent about close to 30 years in the city, 28 years in the city in various capacities. The last 23 years of which was spent in asset management, mostly at BlackRock. So BlackRock and legacy organization. So I actually joined a sort of relatively small UK asset management firm called Mercury Asset Management, which then got bought by Merrill Lynch Investment Management and then got bought by BlackRock. So without doing much, I ended up working for the largest asset manager in the world. And so there's an element of good fortune around that. And I did a number of jobs at BlackRock over the years. I was a fund manager. I studied economics and started my life as an economist there, and then someone thought it'd be a good idea to let me manage money, and I became an equity fund manager. So ran global equities for about 7 years, and then they thought, well, you can have a go helping run the business. So I helped run the active business in BlackRock for a few years, and then for the last few years I had this sort of very grand title, although less grand in reality, of sort of Global Chief Investment Strategist, which essentially meant I was responsible for trying to guide the active platform in terms of investment decisioning, but also I spent a lot of time seeing clients and helping clients solve their problems, which is part of what I enjoyed the most, and partly explains why I am now here at Trinity, because actually being on the other side of the fence, actually being an asset owner, an asset manager, I think is allows us to think in a different way, on a different time horizon than an asset manager would. So Gerhard, you asked me to sort of think about, okay, so what some things I learned along the way in my career at BlackRock, and how can I bring some of those to?
Yes, for example, let's say Isabella, if she switches into investment career, what can she learn from the path you took, your decisions along and so on?
Yeah, so be opportunistic, I think is the main answer, Isabella. So I'd love to say I had mapped this beautiful career and it would end up in a certain place with me sitting at this desk in Trinity. Oh, by the way, for those of you who want to feel nostalgic, it's not so much Isabella, but I don't know if you can see it. I'm actually in Trinity right now.
Where's your room, in Great Court? Or it looks like Great Court.
Yeah, it's in Great Court. So it's, of course, the main reason I decided to join Trinity. A nice office.
Yeah, I lived about 2 years in Queensgate, which is around the corner from you, I guess.
So it's beautiful, and as Bill said, the sun is shining today, so it's a glorious day. Let me share. Isabel, I'm happy on a different occasion. If you decide you want to go in investments, I'm delighted to sort of give you career advice to the extent you want it or indeed need it. I thought I'd share, so indirectly, some career advice here. So I thought I'd share some of the sort of my observations from my time in asset management, and then think about how they can apply to Trinity. Here's a few observations. So first, by far the most important decision that any investor makes, any asset owner makes, is the asset allocation decision. So actually, if you think of an organization like BlackRock had maybe, I don't know, 20 people, 30 people who focused on the asset allocation decision out of 15,000. And the other people focused on either selling stuff there's a lot of distribution, which is important. You know, as a shareholder of BlackRock, you know, they do a great job. They focus on distribution, or, you know, they focus on security selection, you know, sort of arms of equity analysts. Going back to sort of the, you know, comments made before, you know, and I've got sort of at least two people have done equity analysis in the past on the call, but actually relatively few people focus on the asset allocation. So that partly it was hard to monetize, but it's the most important decision. It's the most important decision, and determines your outcome much more than your sort of security specific alpha over a point in time. So the asset allocation decision is by far the most important. For non-specialists, by asset allocation, you mean government bonds versus alternative investments? So I'll give it from a Trinity perspective. I'll bring it to Trinity. So Trinity invests 60% of its portfolio in direct property and 40% in equities, essentially today.
Okay.
That is the asset allocation decision.
Okay.
And then beneath that is the security selection decision about, and then you think about, do you do that passively or actively over time? But it's that high level decision of where do you want your assets to be.
Or venture investments, like you mentioned right now. Well,
So that is by far the most important determinant of your for most investors, your end outcome, unless you go like super concentrated. That is by far the most important.
Okay.
Okay, so that's the first observation, which has, I'll come back to the relevance. The second is that alpha is really hard in most asset classes, although I'm learning actually maybe one exception is property. Before I sat in this seat, my sort of knowledge of direct property investment was approximately nil. I only invested in property through sort of REITs or, you know, indirectly, you know, and somebody thought it was wise to give me a job where 60% of the assets are in, you know, direct property and quite esoteric direct property. So we own the O2, we own most of Cambridge Science Park still, we own Felixstowe Dock, I think you all know this. So these are quite esoteric property. Alpha in most assets, particularly public markets, is unbelievably hard. And so what I would say is, I was an active manager, sort of direct hands-on active manager up in 2012. Yeah, we had a pretty good track record. I can tell you now, like the process we had in place then, that would not generate any alpha today, because you've constantly got to renew, and because it's so competitive, the prizes are so high if you get it right, and there's many people in the call have done this and got it right. That you know, you need cutting edge technology that constantly needs to be evolving. You're the, you know, smartest people. You need to, you know, there's no scope for complacency. You need to constantly review your process over time, and most active managers don't perform, because they charge fees which are too high, and then net of fees, you know, you're essentially the index if you look at the industry. So alpha is hard. You're going to be very selective, and you've got to constantly evolve. And if you're going to generate alpha, you've got to be really clear. There's no one way of generating alpha. There's no other observation. You've got to really be clear where your edge is. And so my one observation that's coming here is that alpha in property seems an awful lot easier than alpha in public equities.
Really?
There are very sort of simple things you can do to add value in a property portfolio, whereas there are very few simple things that are guaranteed to work in an equity portfolio. And the things that are simple are getting commoditized very quickly, and then the alpha disappears very, very quickly. So things like sort of momentum.
So the 60-40 for property for Trinity is quite clever.
It's worked pretty well. I'll come back to it. It's worked pretty well, and it's worked pretty well because lots of alpha has been generated, not because and so we'll come back to what my legacy may be, but you know, there's portraits of John Bradford College for good reason, and he's generated an awful lot of alpha for the college historically. Yeah,
he was amazing. I met him many times for over 10 years. Yeah, he's an amazing man. He was, unfortunately.
But I have heard his legacy.
Just one second. I'll just interrupt you. We've got Emily here now, who just entered, and Emily Shuckburgh. She is the chief of Cambridge Zero. Hello.
Emily and I know each other. Hi,
Emily. We know each other. I kind of headhunted Emily yesterday, and Emily was very kindly agreed to join. So welcome. Thank you for coming.
Oh, no, it's pleasure.
I hope you have a very, very good first question after Richard's
I haven't spoken about sustainability yet, but I will come on to it. So, you know, my favorite, you know, my topic, one of my favorite topics at the moment. So let's go back to, okay, so alpha's hard. That's my second observation, and you've got to really sort of focus on your edge, particularly in public markets. And then my third observation, I sort of alluded to this at the start, is that, you know, like we're at the somewhere in an advanced stage. I don't know if we're at the end of an amazing bull market, and so I'll come back to career advice for Isabella here, which is that you know you want to choose your career where you're in a bull market. And you can interpret that in a broad way, which is like, you know, whether that's in industry, whether it's in farm, wherever it is, that you're in an area which is growing, and you have, and the analogy that one of my former colleagues, head of risk, used to say is like, the analogy was like, how do you canoe fast? And he was into canoeing, and so like, you know, how do you canoe fast? And it's like, well, you get the most up-to-date carbon fiber canoe and the best paddle you can get. You get the best personal trainer. You exercise a lot. You make sure you're maximum fit. And he goes, no. The way you canoe fast is you get in a fast river, and you want to be in a fast river. And this has been a fast river for almost every asset class for the last since 2008. And anything which is sort of tech growth related, and Trinity owns a lot of it up at the Science Park. It's just been a boom. And it continues, and that's going to be a wonderful thing. But the challenge with that is what that's effectively done is drawn forward returns. So, you know, prospective future returns across almost every asset class today are very low when you look forward 10, 20 years, and that's still Trinity's time horizon. And so, you know, my predecessors leave this wonderful legacy of like an endowment which superficially is in great shape. It's, you know, it's very high returns. You know, Rory generated close to 10% annualized returns for the 14 years here, which is like, you know, you compound that, is like extraordinary. I keep trying to explain to people, like, yeah, don't extrapolate that, because I think the future return, and you can see it in the easiest place to see it is in bond markets, where yields have just collapsed. So if you just buy a bond and hold it to maturity now, you're going to get, you know, zero or negative real return. And so returns look pretty low, and so alpha's hard, returns to beta are low, asset allocation matters. Three simple returns. Okay, so in the asset management industry, there are some really, so what are the fast rivers? So these are sort of industry fast rivers, but they apply to Trinity, I think. So the first is index. So like the flow of money going into sort of what's often called passive, up for these sort of index money, it's just relentless. And the price competition is intense. And I'm seeing some really good examples of that right now. We're currently retendering our index mandate at Trinity because we've moved to a new sustainable investment policy, and we're excluding fossil fuels amongst other ESG considerations. So we're effectively retendering for a more complex mandate than the one we had previously. And the price competition around that is unbelievable. And so we are going to be paying, we haven't finished that process yet, we're going to end up paying somewhere between 50 and 60% of what we were paying previously for a simpler mandate. And we're just, and that's just going through the retender process. Also, so you need to retender regularly, because price competition, asset management is a great industry because they have 40% margins. And huge regulatory barriers to entry, but the price competition is now getting unbelievably intense, and Trinity benefits from that, of course, because we're a client. So we, and when you think about low returns, that my point is like future low returns, then how much you pay suddenly matters a lot. And if you're generating 10% annualized returns like my predecessors generated, then if you pay an extra 10 basis points for your fees, it's not going to kill you. You're still getting massive returns. Whereas if your prospective returns are very low, how much you pay for those returns is really matters. So I'll come on to what I'm focusing on, but cost is one of the things I'm focusing on. And we are, I think we can significantly reduce some of the costs. Okay, second big trend in the industry is something called factors. Now, factors are potentially today what cutting edge alpha was 10 years ago. And so what are factors? Factors are broad and persistent sources of return. So these are things like momentum, quality, value. So broad, buy cheap things that are going up. These are broad and persistent sources of return. And this is literally cutting edge alpha. This is like the first quant investors invest in this stuff. And the problem is now that you can buy this for tiny fees because you can commoditize it. And so understand what your returns are and think about your factor exposure. And I think that applies to Trinity, because today we have 7 active managers in our endowment, but they're all growth managers. So when you add them up, what you've got is a big growth bias. So it's been amazing. Yeah. So great decision by Rory, because all of them have massively outperformed, but they've been in this fast river. It's been pretty hard for a growth manager to have underperformed in the last decade. And really what we've got is some security specific alpha, but an awful lot of factor exposure, which has been the right factor exposure. So think about how much you pay for that. Okay, that's the second. Third big trend is private markets, where I think at least 2 people on this call are on the right end of this, which is that the flood of money going to private markets is extraordinary right now. And it's because all like pension funds, anyone who's got long-term liabilities, know they can't reach that, they can't meet those liabilities in public markets anymore. And therefore the stretch for yield, the stretch for return in private markets is huge, and there's a huge amount of money going in. And it has, I'll come back to, it has implications for Trinity. I do worry about, this is a hot market, and I worry about the sort of the entry point. And then the fourth is ESG investing, which is has gone from being something which was quite niche, maybe 5 years ago, 10 years ago, to in the last 2 or 3 years, 9 clients out of 10, 9 investors out of 10 that want to have some aspect of ESG in the way. Hi, Joanna. Some aspect of ESG in the way they invest. So there's like huge flows into ESG, and the asset management industry needs to change, and it's something I've been focused on here for Trinity as well. I'll come back to it. And actually, there's a fifth trend, which is not really a trend, but sort of an aspiration, which is like China, which is that China, both from the industry, is like think about China as a source of a pool of assets, but also the impact of China on the global economy has been a key trend, and actually monetizing that is hard, and thinking about exposure to China. And I can come back to all of that, which is I think almost all aspects of that has implications for how Trinity runs its endowment over time. Maybe I'll come to that. So I joined Trinity in September. I'm effective as Gerhard. I'm trying to figure out what Senior Bursar means still. Vanessa does a very good job at trying to remind me from time to time. There is no corporate analogy. It's a bit chief investment officer, but not really. It's a little bit chief financial officer, and there's an element of fellow around it. And there's definitely an important aspect of being part of the college, but also influencing how the money is spent. So it's not just about managing the money, it's also having an influence over how the money is spent wisely over time. And I think Gerhard, in sort of a conversation before this, you said, so what do you want your legacy to be? And I'm like, well, hopefully my legacy is simply that the endowment is in better shape when I leave than when I've joined, which is a high bar, because it's in good shape. And secondly, that we've spent the money wisely. And we can look at having spent the money wisely and be proud of how we've spent the money. And as a result of that, Trinity is still, the UK's leading academic institution and one of the leading academic institutions. It's not just
about the money. I mean, if you look at what Bradfield did, with the science park, it's kind of a different dimension. Huh? It's of course it's about the money as well, but money plus.
So the science park is a good example where it's about the money, it's about influence on the university, the collegiate university beyond Trinity. It's about influence on the city and on sort of brand and around technology. And actually the science park's a really example where sort of, I think of a Venn diagram, it's like absolutely the center of that, which is sort of influences all the things that Trinity wants to be. It, academic excellence, about investing in future and technology, about influencing, I studied here in the late 80s, left in 91, and Cambridge is a different city than when I was here, and partly it's a different city because of what's happened in the science park, and now it's one of the the two sort of major tech centers in the country, particularly biotech centers. So, you know,
not just in the country, I mean,
yeah.
global impact. It's got global impact.
So it's a high bar. Okay, so let me talk a bit about the endowment, the issues I'm focusing on, and then we'll take some questions. So the endowment today worth about just over £1.5 billion. So, you know, that's big for Oxbridge College, you know, numbers, not big for many of you for the way you invest money, and not big for BlackRock in the, you know, $10 trillion company, investment company. But it's actually it's an endowment which in capital terms has done really well over the, you know, many years. The investments have, you know, been extraordinary, particularly the science part, but also Felixstowe Docks has been quietly actually just as impressive in terms of what it's done for Trinity's finances. Some very good decisions on the equity side by my predecessor. So I've mentioned one of them, that sort of growth bias, done really well over time. So that's, you know, in capital terms, done very well. Income terms, we have a challenge in the college currently, and Bill's been in many of these conversations with me, that, you know, the college currently accounts for income. So the endowment funds 3/4 of the college's expenditure, essentially. So you should think about the endowment generating 3/4 of the college's overall income, the rest coming from students and from, you know, accommodation, etc. But the income is down very hard in the last couple of years because of COVID. You know, so dividend income is down, rental income is down on our rental properties, but also we haven't had all the students here. So, you know, we're not getting catering income, we're not getting rental income. So we've got this big income deficit at the moment, about £8 million deficit, but the capital is great because, you know, the equity markets are record highs. The science park is booming. I mean, literally booming. You know, science parks is the property equivalent of a FANG stock in the UK. You know, it's been amazing, and we've got some losers. We own a lot of city centre Cambridge retail for legacy reasons. It's not fungible, and, you know, it's probably not saleable, to be honest. It's, you know, it's more of a liability than an asset. But we want Cambridge to be getting back to our civic duty. We want Cambridge to be a successful city that looks nice, and people, you know, which people like, with shops that are open. So, you know, I view this as, you know, we're a charity, but we're providing almost sort of charitable donations to City Centre Cambridge. But we've had a lot of winners. So so we're a capital-rich college, but we're income poor right now, and that's, you know, that's a challenge for us as we think through, you know, what the true investment objectives of the endowment should be. And we've never really had this challenge before because both income and capital have been growing rapidly over years. And then we're also trying to figure out exactly how much we need. So, you know, so Trinity, the endowment help funds, I think, of core expenditure in the college, by which I mean is like, what does the college need to perform as a world-leading academic institution? And that's about paying for the education. It's about maintaining the buildings. You know, also those broader aspects. But Trinity also historically has spent a lot of money on other colleges and on the university. It's, you know, so it has more money than it needs. I think we don't quite, and it's never really had to ask this question before because we've not faced the challenges we're facing now. We're trying to understand exactly how much money does it need. But we're facing some, we're facing some income challenges right now, which lead into sort of what I'm focusing on. So what I'm focusing on, so actually I'll start with that. So one of the things is actually really looking at what, over sort of long horizons going forward, what are reasonable expectations for returns from the endowment, and then link that to what do we think is going to happen to the liabilities of the college. So the liabilities essentially mean that those obligations, maintaining the college as a world leading institution, and then thinking about how much money we have, what we should be spending that money on over time. And then within the endowment, what does that lead to? Leads to a few conversations. So one has been a big focus on sustainability. Emily's been involved in many of these conversations. We recently announced a change in our investment policy back in February. I'm happy to take questions around that, but we're now in the process of executing on that. And so evolving the portfolio so it's on a path which is consistent with carbon neutrality, hopefully well before 2050. I'm looking at how to diversify the portfolio. So Gerhard's like, what do you want your great sort of legacy to be? And, you know, so John Bradfield transformed Cambridge in the world, and you know, what's yours going to be? And my hope is I'm less ambitious than that, Gerhard, which is like, I just hope the endowment's still there and, you know, has grown. And yeah, you know, so I think the way I'd articulate it is many of my predecessors made Trinity rich. You know, and Trinity has, you know, a large endowment, which should be enough to sort of fund its, you know, like core activity. And Trinity has ambitions well beyond that core activity. But you know, my job is to keep Trinity rich, and that involves less about taking really concentrated, successful bets like the science park, and more about how do we diversify our sources of returns going forward. So it's
more like a risk management type of.
I think it's an element of risk. Exactly. We've taken some big, relatively concentrated decisions which have proved to be spectacularly right, and over time, you know, the question is which of those do we want to double down on? And things like the science park actually look. I think there's huge growth potential in the science park going forward. So we're a long way from the end of that story. But how do we make sure the portfolio is resilient in a world of uncertainty and low returns going forward? And how do we diversify those different sources of return in the future? And then linked into that, I touched on this earlier, is that this sort of link between alpha and beta. Make sure we're looking for alpha in the right place, and we're paying the right amount of money for it. And so we've generated most of our alpha in property. Actually, it's and there are sort of relatively simple things you can do on property, which is like, you know, buy a field, be patient, get planning permission, and sell the field at a dramatically higher price. And you know, this is alpha. And actually, the main benefit Trinity has there is patience and a relatively low cost of capital. So you know, there's many examples of where we've done this, and you know, bought a piece of land and just been very patient around that and developing it and made significant alpha. But then you've got to think about where's your edge in doing that, and a lot of that edge is around Cambridge. And there's a sort of an element of looking at the portfolio. Now we've got quite a sort of complex property portfolio. We own 443 properties. You know, 3 slightly unfair comparison, but 3. It's not 3 properties. It's 3 assets. The science park is not 1 property, but 3 assets have generated the vast majority of the return on that over the last couple of decades. Private markets I talked about, and today Trinity has 1% of the endowment in private markets of venture capital, private equity.
You mentioned at the beginning you want to emphasize that
1% is the wrong number, and so what I say, by which I mean that 1% had like no scope for that to generate any material impact on the college's return. And actually, if we look back in history, that 1% has generated a return actually slightly below public equity. So it's not, it's kind of diversified across 12 managers. So it's the wrong number. So even if it doubles, it's not going to materially impact returns. And it's super diversified across 12 managers, and it's a headache. And it's a headache because there's lots of cash calls and accounting challenges. And so the sort of, the cost benefit of analysis of that today is heavily tilted towards cost. And so we're looking hard about actually, is this an area we want to expand in? Because Trinity has naturally a very long investment horizon. We have amazing alumni. So we have a lot of access to private markets. We have the former master who's founded 3 biotech companies and sits on the board of 2 different venture capital firms. There
are more. I mean, like Richard Friend, for example, who is now honorary fellow, but he's Cavendish professor. He also funded many companies.
So Trinity has an edge here, I'd say, and actually, so you can think we've got and the time horizon. So we don't need liquidity. We only take about just over today. We take about 2% out of the endowment every year for income, and again, we should debate whether that's the right number we're taking out. But we don't have a huge liquidity need, which means that we can afford to take long horizon investments, afford to earn an illiquidity premium. And then think about how we invest to generate returns on that. And the question is this the right time, and really about how we would do that. But say 1% seems the wrong number in private markets. But then there's a big question about if we were to build that up, how would we do that over time, which is likely to generate a high return. And one of the things about private markets is that there's lots of scope for alpha, but there's also scope for negative alpha. And if you look at the 12 managers we've selected over past, we've got both. Yeah, so we've got some like big winners, and we've had 2 dogs. And so it's about how do we create, and that's why the net result has actually been after fees less than public equity over the period that we've held the private market portfolio. So if we're going to do this, how do we do it in a way where we can be confident we're actually going to earn that additional risk premium over time? So we're doing a considerable amount of work around that. And then there's a lot of work actually on the alpha side around property, because I think there's lots of areas where trying to understand, well, where should we be investing? What do we think the winners are going to be? And how do we think about making sure we're putting the capital in those areas? And where do we potentially divest from? Because most of the return for property has come from adding value over time. It's not come from like sitting on a static property portfolio and earning income off it and waiting for capital values to rise. It's been about turning, some fields up on, north of Cambridge into the science park that we own. It's been about turning some fields in Suffolk into Felixstowe Dock by Cillian Nicholas before. So, this is alpha. This is like adding return, but the property market as a whole, on any perspective, is not going to generate RPI plus 5, which is the college's goal. So it's about how can you generate alpha and make sure you're concentrating the investment returns where you think you can generate alpha and high returns going forward. I'll pause there. We don't have a huge amount of time, but I've covered sort of quite a lot of ground, but really happy to take any questions. And I'm also really open for advice. I'm relatively new to Trinity, which we're trying to navigate it, trying to add value. One of the appeals of Trinity is we've got an extraordinary student network, which I've actually really enjoyed engaging with and learning from, and an extraordinary alumni network. So I don't have all the answers, so I'd be delighted to go hear other people's perspectives.
Thank you so much. I mean, normally we have this as dinners in Tokyo. So when the travel is more realistic again, maybe you can join one of our dinners here. That would be fantastic. Now, I was thinking.
I used to come to Tokyo, not that often, maybe once a year actually. So I had early in my career, I had Japanese clients who I used to go more frequently.
It would be fantastic to have a dinner with you here in Japan.
This is an aside, but I love Japanese food. And you want to take me to a dinner in Tokyo? I'll get on a plane to come to Tokyo for like,
You should. We have the invitation. I'll send you some photos of where we usually meet with the food. I think one thing which we in your presentation, which was relatively short, was this issue of Cambridge Zero and Trinity Zero. And we have Emily here, who is the chief of Cambridge Zero. Emily, maybe you like to talk a little bit now and maybe make a comment or the first question.
Oh, thank you very much. Yes, so, well, let me just really briefly tell people what Cambridge Zero is, which it's the university's initiative to support everything in terms of climate action through the university's research, through its education, through its wider engagement with policy, with business, with the sort of startup communities that Richard touched on briefly, but also in terms of the university's the collegiate university's own actions in terms of the institution's decarbonisation, including through its investments. And so you'll be aware that the university centrally, as well as Trinity, have moved to decarbonise their investments. And that's been a really important part of what both Trinity and the university have been doing. And I've, as Richard said, Richard and I regularly catch up and engage. And I've also been involved more generally with the college, thinking through how we look to decarbonise the college estate and activities. So, I mean, in terms of a really quick question, because I know there's not that much time left, but I mean, I'd be interested in your thoughts, Richard, as you know, obviously before Trinity took the decision to disinvest from certain sectors around climate change, there was often comments that, oh, you know, to do so would go against fiduciary duty and would hit returns and so forth. I mean, now that you started to move in that direction, what would your viewpoint be in terms of the impact that as you see it at this point?
Yeah, so I'll give it both sort of before and after. So the biggest hurdle to getting the college to agree to a change in policy was getting the college to be comfortable that actually having environmental goals, so that the goal is to have a significant, lasting, positive impact on the environment, that was consistent with the college's financial goals, which in our case are RPI +5 long run and RPI +1 income growth over time. And those two things were consistent, actually complementary. And actually spending a lot of time with the investment committee to get the investment committee comfortable that was the case. So that, you know, that was the big hurdle, because because we want so the way it's been sort of put to me, I think about it, is that if Trinity wants to solve climate change, then actually how we invest the 1.5 billion endowment, we choose not to invest in Exxon, it's not going to solve climate change, but actually if we can generate very high returns and fund research across the college and actually act as a convener, then that is much more productive way in which Trinity can address the issue of global climate change. So actually not compromising returns whilst also investing in a responsible way was core to what we wanted to achieve. So now we're doing it. So I could share two perspectives. So the first is on the equity side, and I touched on this earlier on the index mandate. So there's a concern, like, you get that if you change your equity mandate, you divest from fossil fuels, it's going to cost you more, and you're going to limit your field. So there'll be a group of active managers who just won't be able to invest in because they won't meet your new criteria. And I can tell you on both sides, both parts of that is just simply not been true. So on the index side, I touched on this, actually the opposite has been true, but that by retendering, we have actually cut fees by about 40% and maybe more. And so the willingness of that's just telling you about the price pressures in the industry and the need for the asset management industry to deliver product which meets current clients' needs. We're not the only people looking for these types of mandates. And so on the sort of index equity side, we are saving money. So it wasn't the reason we did it, but this is the outcome. Actually, we're going to end up with a lower fee structure. On the active side, we have 7 active managers, two of which do not meet our current criteria. One we had already decided to terminate prior to my arrival, and so we're just accelerating that process. So that termination was nothing to do with their fossil fuel exposure. It was broader issues. So they're terminating, but the other one are going to run a separately managed account for us, which excludes fossil fuels. So actually, at the same price, which is, by the way, which is also an interesting example, because we're currently invested in their fund. So they're going to run a separately managed account, which would normally, you'd normally charge more for, quite a lot more for. They're going to do it at the same price and exclude fossil fuels for it. So what it tells you is the industry is moving. So on the equity side, very high degree of confidence that this is not going to cost us any alpha. You lose a very marginal degree of diversification, but in practice you can offset that. And actually, what I'd argue is you're reducing risk in other ways by reducing your fossil fuel exposure. So on the security side, I think very compelling real world evidence that this is not going to cost the college anything. In fact, it's saving us money. And so the risk return profile is improving from doing this. The property side is more complex. And, and Emily, I had a conversation about Trinity in this respect. And there are other examples now where if you want to build a building and if you want to build it to a very high carbon standard, sort of low carbon footprint, it costs you more typically to do that. And if you then want to sell that building today, you would not be fully compensated for the additional cost of doing that. So if you've got a short-term investment view, which is like, we're going to build something, set it to a high green standard and sell it, then there's a cost, and then that's going to create a challenge. We're going to have some tests of this going forward. The good news is if you have a long investment horizon, there's actually a lot of evidence that buyers are starting to pay more for more ethical buildings, because every every business in the country now has a net zero target, effectively, and so actually they care more. So the pricing is starting to move and rents are starting to move. So I think if you're a long-term investor like Trinity, it's more evidence you can put in some of these costs now, because what you're doing is future-proofing the portfolio, and you will get paid in the future, but you need to be patient to do that. Where it's a bigger challenge is if you're selling now, because there are a number of examples where we have property, or we've got planning on that property, and then we want to sell. So we don't want to, we're not house builders or not developers. We want to sell. But if we set a very high ethical green standard around those sites, then the money that we will get paid for those comes down, because essentially the buyers will say, well, we're going to discount that because it costs us more to put in ground source heat pumps rather than just gas boilers. And that creates an interesting dilemma for the college, because the question is, as a fiduciary, actually, can we do that? Can we accept a lower price to improve not our carbon footprint, because we're selling the land, but actually someone else's carbon footprint? But we should care about someone else's carbon footprint, because what we care about is the world, not just getting to net zero. So there are going to be some interesting challenges coming up, and interesting discussions about, I say the good news around that is that the whole industry is moving so rapidly around it, and the sort of bar and the regulation is changing, that actually, and here's sort of the regulation I say as our friend, where regulation is catching up, which means that almost all properties now you need to put in planning permission, which is above the existing sort of minimum planning standards, because regulations change over time. But we are going to face some some decisions in the future. But again, what our goal is, like, can we meet these standards and at the same time achieve our returns? And to answer those questions, we're working with we've appointed a consultant who we're working with really as a partner called Eunomia, helping us build a carbon baseline, so we actually really understand the carbon footprint of the entire endowment, most of which is going to sit in the property portfolio, and then understand that where can we reduce that carbon footprint most effectively at low, or in some cases zero cost. And what we also know is we are going to end up with some residual carbon in 2050. We're not going to get to net zero by simply reducing the carbon footprint of our current holdings. We're going to have to do some other things, and we're looking hard at what those other things may be.
Just wanted to jump in. Sorry, I didn't introduce myself properly earlier because there was something going on in the background. So just to introduce myself and why I was interested in joining this. So I came to Trinity as a Gates Scholar 06, 07. So that was the time when Cambridge was just launching the 800th anniversary capital campaign. I did my undergrad at Harvard. It was fully paid for. Cambridge was fully paid for through the Gates Cambridge Fellowship. And so that year, it was very much on my mind, like endowments play a huge role in, what a university can deliver and what it can create. And I had an amazing experience at Trinity. They covered courses and trips that the Gates Cambridge Fellowship did not cover on its own. So, I think the interest here is just to see how far we've come. Just a couple quick thoughts. So, before moving more in the tech direction, I used to manage a $700 million private equity portfolio in Hong Kong. And before that, I was actually doing real estate private equity at Morgan Stanley. And so what I will say is just quickly on the real estate, there is a lot of evidence of alpha actually for office and commercial assets, because there are certain types. If you have large office buildings, you systematically generate higher rent. And I had some, happy to connect and send you a few groups that work on this. And at the scale that Trinity is at, you can set up separate mandates. And there are a lot of funds that already incorporate this. And then just on the private equity side, I invested in a lot of very, very high performing Chinese tech and private equity managers. Happy to share some names, because I do agree 1% is on the low side. Question for you actually is, I think one thing we did come to, and I think talking about Cambridge Zero is moving in that direction, like beyond financially what the endowment does for the college, for the university, because the college is also very generous with other parts of the university. There's also a huge, like, you're a thought leader, right, in this space. And I think you started alluding to this, like in terms of when Trinity decides they're going to divest from carbon, a lot of people will start looking at that, beyond the financial legacy that you are hoping to leave in this next phase of building out the endowment. What else are you thinking, or are you starting to think about in terms of impact, or how Trinity is going to establish thought leadership just among endowments or other foundations, about how they manage money and what they're saying in how they manage money. And to your point, I mean, I loved your answer to that question about net zero, because there are a lot of ways to get alpha and build in some of those things. But curious to know how you're thinking about this. One final thought just on that, actually, I previously invested in an AI company in Silicon Valley. It's now gotten acquired by one of the financial data companies, but it actually generated like real-time ESG data. And what they did that was actually very interesting, because they did research jointly with Harvard Business School, and they found systematic 3 to 8% per annum alpha in publicly traded equities within their universe when they incorporated those ESG factors. And one of the main things that was actually really important is that they weighted the ESG factors for materiality. So the ESG factor that a company is like focused on and that they're scored well on, that you look at when you include them in your portfolio, has to be something that's material to their industry, because otherwise there's a lot of like impact washing, right? I could say, I'm a highly polluting company in like the supply chain I'm working with, but hey, I have like 80% minorities on my board, but then that is not the main impact, right? But the main impact is what they're doing with their supply chain. So I think that's another thing, just to throw that in. I think it's very exciting that Trinity is thinking very seriously about it, and congratulations on this new job. But yeah, curious to know your thoughts on the legacy.
Yeah, well, thank you, Joe. And first of all, I'd love to connect and hear more about those areas. I really love your question, because actually I think about Trinity's endowment, it's like 1.6 billion. I said it's large, but it's not huge. And actually Trinity has a voice and a degree of influence well beyond the size of our endowment. And the example we're seeing now around that is about sustainable investing, and our view is like, Trinity can influence, we can influence others because we have a voice and a brand and respect around that, far beyond the direct impact from shifting our portfolio, and think about what's the right way to do that, what's the right way to communicate, to engage with others, to engage with the company we invested in. And there's always been some nice examples actually where we've signed some resolutions against HSBC, and actually more recently, the McDonald's resolution, Isabel, that you would have been involved in on AMR, and actually we managed to get others involved in that because of Trinity's brand. We are building a plan around COP26 to think about how we can play a role there. So it's about how and then there's the aspect about how can Trinity potentially fund research. I think what's sort of unique about Trinity, well, it's academia, and therefore how can we link some of what we're trying to do to research and actually fund potentially a couple of fellowships in this area. So when I think about sustainability as one example, or actually carbon zero is one example, it's what I like is it's really complex. We're not good at measuring it. We don't, people, so many different definitions of what net zero actually means, and actually particularly in the property portfolio, it's no one's really got answers about how you do it, and yet we have a group of fellows here who are extraordinarily engaged around this and prepared to give their time. I've discovered that we have a network of people externally who want to get involved in this, just because they're interested. So we're head of sustainability at the National Trust involved with Professor John French from the university involved. I won't go through them, but the sort of the Trinity name draws people in who want to have an influence, and part of the reason I'm here is that appeal to make a difference and to sort of influence others. So we can see that in terms of sustainability, but I think there are other aspects of the endowment over time as well, where we can influence others and help them make better decisions. So, some of that starts locally in terms of the networks we have in terms of the other colleges and how we engage with the university. But some of it goes, well beyond that. And at this stage, I don't have all the answers. But what I do know is that I think there is a scope to do things better and to, if I'm honest, to engage with our alumni better. I don't think we've always done a great job of kind of articulating to alumni what we're trying to achieve with the endowment, or indeed what the endowment is for, and why why you might want to contribute to it, because Trinity is very rich and what you're spending the money on, and so I think there's a messaging piece around that which we need to get right.
You're doing this right now.
Yeah, and there's a bit to do, but broadly, I love the question because I think it's exactly the right one, which is I'm hopefully going to be here for 15 years, so hopefully the endowment's in good shape when I leave. If I'm honest, like the direct investing bit of this job, it's interesting. We have a sort of super long investment horizon. It's an interesting portfolio. But I've done a lot of investing for a long time, and if I just wanted an investment job, this wouldn't necessarily be the job I would do. What I'm here is actually, I think, the ability to go well beyond the traditional boundaries of investment, to communicate, influence others, make a difference, and leave not just Trinity in better shape, but hopefully Cambridge in better shape, and if I'm super ambitious, the world in better shape than when I joined, with the help of with the help of others. And I think some of the issues around private markets fall into that, which I think there's a bit of a gold rush to go into private markets right now. But I think thinking about how do you do that in a way where you're most likely both to generate a high return and to have a positive impact on whatever you want to have a positive impact on, but how do you do that? And how do you build the network and structure and governance around that, I think is something Trinity could have a positive influence on over time. But again, I'm looking for others to help me. Thanks, John. Gerhard, I'm going to have to apologize because I have 1 minute left.
Okay.
And Vanessa is very, very strict. So I'm due somewhere else in a minute's time. If it's one quick final question, I'm happy to take it, but otherwise, happy to wrap up now.
Okay, maybe if Isabella has one more question, maybe.
No, all my questions have been answered already. So. Yeah.
Okay, good.
I'm sure if I come up with any more, I can just see my questions.
Richard, thank you so very, very much for giving us your time and energy for this fantastic talk. Where's Richard now? He's gone.
I'm still here.
Oh, you're still here. Thank you so very much. This was fantastic. I mean, you gave us a very, very good overview of your plans here and how you want to go beyond just the money side of things. And I completely agree with you that I think your communication can leverage. I mean, Trinity with 34 Nobel Prize winners and many more very fantastic researchers and results over many years. Trinity makes so much impact in the world. So I think you can multiply it with investments. You can.
One thing, honestly, I feel so privileged to be here. Not just because I look out over Great Court, it reminds me, but I'm working every day with people who won Nobel Prizes or field medals, and it is humbling. And they're interested in how the college invests, and they want to help. And I have to say it's been a great experience.
I mean, this magic is for all of us, really. I mean, we all feel this magic. I was 13 years in Trinity, so it's like carries on, the magic. Yeah.
Very good. Well, thank you all. Pleasure to meet you all, and be very happy in the future come back and hopefully tell you some good stories about what we've actually done and achieved rather than aspirations over time. So thank you
so
all.
much. Thank you. Bye bye.
Bye bye.
Thank you. Thank you, Gerhard, also.
Yeah, thank you, Clive. Thank you, Bill. Thank you, everybody.